What if you could get all the benefits of a mutual fund? Diversification, simplicity, professional management, but with lower costs, more control, and the ability to trade it like a stock. This isn't a futuristic investment. It's available right now, and it's called an ETF. Stay with me, because in the next 5 minutes, I'm going to show you why ETFs might be the smartest investment you've never made, and how you can start with just 250 rupees per month. Welcome back to the channel. I'm Your Name, and if you're serious about building wealth with smart, low-cost investment strategies, you're in the right place. Last time, we talked about mutual funds. Today, we're taking it a step further and diving into their smarter, more efficient cousin, ETFs, or exchange-traded funds. If you've ever felt that mutual fund fees are too high, or wished you had more control over your investments, then this video is for you. I'm going to break down exactly what an ETF is, how it's different from a mutual fund, and why it could save you lakhs of rupees in the long run. Let's get started. Imagine you're at a supermarket. A mutual fund is like a pre-packed fruit basket. You get a variety of fruits, but you don't choose them, and you pay a little extra for the packaging and service. Now, what if you could buy the same basket of fruits, but pay for it at the checkout counter like any other grocery item, with no extra service fee? That's an ETF. ETF stands for Exchange Traded Fund. Just like a mutual fund, it's a basket of assets. It can hold 50, 100, or even 500 different stocks. But here's the key difference. It trades on the stock exchange, just like a single stock. So you get the diversification of a mutual fund, but the trading flexibility of a stock. You can buy and sell it any time during the day at a live price. This one difference changes everything. Think of it like this. A mutual fund is like taking a bus. It has a fixed route and a fixed schedule. An ETF is like owning a car. You have the freedom to drive wherever you want, whenever you want. More control, more flexibility. So, why should you care about ETFs? Because the differences between an ETF and a mutual fund can have a massive impact on your wealth. Let me show you. First, live trading. As I said, ETFs trade on the stock exchange. This means you can buy or sell them anytime between 9:15 a.m. and 3:30 p.m. at a live, real-time price. A mutual fund, on the other hand, is priced only once per day after the market closes. This is called the NAV, Net Asset Value. You don't know the exact price you'll get until the end of the day. With ETFs, you have full control over the price you buy or sell at. Second, and this is the most important one, the expense ratio. This is the fee you pay every year to the fund house. Actively managed mutual funds can charge anywhere from 1% to 2.5% per year. Now, 1% might not sound like much, but let me show you how it destroys your wealth. Let's say you invest 10,000 rupees per month for 20 years with a 12% annual return. With a 1% expense ratio in a mutual fund, you'd end up with approximately 89 lakh rupees. But most ETFs, because they are passively managed, have an expense ratio as low as 0.1%. With that fee, your final corpus would be around 96 lakh rupees. That's a 7 lakh rupee difference. That's a car. That's a down payment for a house. That's your child's college fee. All lost to fees. ETFs put that money back in your pocket. Third, transparency. With an ETF, you know exactly what stocks it holds every single day. The portfolio is completely transparent. Mutual funds, on the other hand, disclose their full portfolio only once a month. With ETFs, you have a clearer picture of where your money is invested. Fourth, the SIP mechanism. Here's the one small catch. Mutual fund SIPs are fully automated. With ETFs, you often need to buy the units yourself every month through your demat account, just like buying a stock. However, many brokers now offer features like baskets or automated SIPs for ETFs, making it just as easy. Now you might be thinking, this sounds great, but isn't it for big investors? Absolutely not. You can start investing in ETFs with the same amount you'd start a mutual fund.